Today we have a special guest, John Reed with Balanced Strategies. I had the pleasure to work with Balanced Strategies for a couple of years now with Justin and their team. They have an extraordinary team. A lot of people, brokers, agents, independent financial advisors, CPAs, come to us and ask us about what premium financing is and how it works. When is it appropriate for a prospect or a client? And then in general, just having enough comfort level to be able to present large cases and large complex strategies for individuals of high net worth or that have large assets that would want to transfer or create a succession planning for themselves, their business, and their family. So I thought today would be a really valuable opportunity for all of those brokers and professionals to learn what it is and who's better than John Reed from Balanced Strategies to share those ideas with us and to bring us knowledge and valuable information. So without further ado, please, John, take it away.
Thanks, Adam. And I think what I'm excited about today is to go through really the thought process behind how do you structure a premium financing case? What goes into an analysis? Most times whenever Adam picks up the phone and calls us, it's, hey, we have an engagement. We're working with a client who's looking to do a large estate planning strategy. They're implementing a business plan. You've talked through your irrevocable trust. You've talked through estate tax. You've talked through buy-sell obligations and how to efficiently transfer a corporation. A lot of those conversations have already been had. And now what we're looking for is, how does life insurance play a really important, vital role in that planning? And if we know that insurance is going to be used, what's the most efficient way to structure it? That's what we're going to go through today. It's an analysis. It's not a presentation. It's not a sales pitch. It's really how we think about and talk about premium financing. So I'm going to share this screen with everybody. And is this on your screen now, Adam?
Yes.
All right. So this is the document that our firm, Balanced Strategies, uses for every conversation around financing. This document really is used in three different versions. Not three different versions, but it's used in three different meetings. The first meeting is in the initial design review, we call it. That's where my team and you, Adam, and your team, the advisor, we all get on a call, a screen share just like this, and we review this analysis together. This analysis is going to break down what is premium financing, how do we approach the market, what are the risks and special considerations of it, and then when we model out what are the considerations for cash flow, for paying interest, where are we looking at, what's the flexibility for repaying the loan, what is ultimately the death benefit for the beneficiaries of this contract. Now, that's the first purpose of it. The second purpose of this is that when we meet with a client, whenever we're engaged, we will present this as part of the advisory team to the client and the entire team. It's going to be used in the exact same format. Nothing we present will be for the first viewing time for the advisor. Anyone who asks us to get engaged on a case, they're always going to review this first. That way they can put their eyes over it. They can make sure that it's still an appropriate fit for their clients. And finally, one of the things you'll notice on this document is that at the bottom of each page, there's a spot for initials on this, and every single page has it. And that's because this becomes part of the living document package and the case file for the client if they do choose to move forward. This important notice says, very frankly, that this analysis is the combination of two things. It's the combination of a life insurance policy and it's the combination of a third-party loan, typically a third-party loan. And it's only by looking at what are the contracts for each of those and what happens when we combine them together, that's what this analysis is. And it's not complete without that carrier illustration and without that the loan provisions and terms as well. We follow a pretty structured approach when we go through this analysis. We want to make sure that we're laying the foundation in a logical order and that we're not leaving any stones of risk unturned in the conversation. So we're going to talk through what is premium financing at its basics. What are the special considerations if a client chooses to finance their policy versus paying for it directly out of pocket? What does the entity and ownership structure of that look like? There's two unique components of a finance strategy. We're going to dig into those in more detail. And then ultimately, we're going to talk about how our firm goes to the market of lenders in a very similar way to how we go to the market of carriers. Where do we go to figure out what's the best and most efficient source of capital for this client? Finally, after we've gone through all those foundational pieces, then we actually dig into the projections. We look at what is the projection of the policy at a typical performance level, a conservative level, as well as what are the guaranteed minimums of the contract. Because we want to see that entire range of outcomes of if we implement a strategy like this, what is that client journey going to look like now and for the long run?
Fantastic. And if I can pause you for a second, one of the ways and one of the reasons that we chose to work with Balanced Strategies, even though we have experience with other companies, is because of the fact that they are having all of those disclosures. They're super professional. They are not leaving any information unexplained or, lack of transparency. I mean, they're very, very transparent. They're super professional, and they're doing everything involving the agent and making sure that the agent is the hero, and they're like their superpower in the background, kind of helping us moving things forward and supporting us along the sale and along the recommendation process. So I wanted to mention that as well.
Oh, thank you. Yeah, I think that's one thing that we definitely take seriously is that if a client asks a really hard question, that's where we shine. It's digging into and understanding not only what is their concern, but also analyzing and quantifying what is the true risk, what is the exposure they have, and making sure it's a plan that satisfies their risk tolerance. One thing you'll never get from us is the waving away of problems. Oh, that'll never happen. That's not something you'll hear from us. It's, what if that does happen? What can we do to prevent it? What can we do to mitigate the downside potential of it occurring? Things like that. And that goes into every step, every stage of the analysis and the discussion long term. So without further ado, the premium financing, I think, has been it's been presented as a strategy in and of itself. It's been coined phrases. There's been trademark names around it. But at its most simple, it is the combination of a life insurance policy being funded by a third-party loan. It is those two components together that makes a premium financing arrangement. What we look for is a fact pattern that has really three steps. Number one is that in support of planning, there is a need for life insurance. Most of our engagements are for death benefit. They're focused on having the death benefit pay out at the passing of the insured or insureds. Number two is that the clients have the financial wherewithal to afford the policy. They have the ability to pay for a permanent contract. But number three, the third piece we look for is that they have a better use of capital somewhere else. They feel they have more efficiency from a return on investment, from a capital markets exposure, from a capital gains tax exposure, from a state transfer efficiency. There's reasons why they are choosing to use third-party funding. And it's because of its efficiency based around their plan. We are not in the business of presenting free insurance. We're not in the business of showing maximum arbitrage between borrowing rates and crediting rates. This is in support of a planning engagement. And so the structure that we look at is that, again, it's a commercial loan. It's a life insurance policy owned by an entity, typically an irrevocable trust or a corporation. Ultimately, that loan is repaid. All the interest has been paid, and the remaining death benefit or equity in the contract is available for the beneficiaries. Now, again, the reason people choose to do this is because it frees up cash flow. If you're looking at a couple $100,000 a year of premium as an obligation to fund a life insurance policy, and you're getting a better rate of return in your corporation, this allows you to do both, build the life insurance contract and enjoy that appreciation at that higher rate in your corporation. Now, if you're illiquid, your client has significantly invested in illiquid, perhaps real estate assets. This allows us to come up with the cash flow to pay for the insurance policy without having to sell properties in a down market or an inopportune time before they're done with the property's growth. As well, we may be able to provide leverage. What I mean is that the dollars that someone's servicing interest with, you may be able to buy significantly more death benefit during those interest-paying years. And as well, relating to gift taxes, when we look at If we look at a grantor who needs to move a couple $100,000 per year to an irrevocable trust to fund a life insurance policy, it may be over what they can gift annually. And so what we look at is if we can get an interest payment which falls within their annual gift exclusion, we may be able to have a really efficient estate strategy for someone who's facing estate tax exemptions and being very strategic about what and how they're passing assets. Now, there are risks involved. Some of the risks are unique to premium financing arrangements, and some of them are just the risks associated with life insurance and how it's funded. One that's very unique to this is that there's interest rate risk. These are typically variable rate loans. Now, we can get very custom on them. We can do fixed rates, we can do caps, we can use swaps. So we can get as sophisticated as we need to stay within the risk tolerance of the client, but there is risk around those interest rates. As well is that depending on what funds are being identified to repay the principal, there's rate of return risk. If we're expecting to have growth on assets that's going to be used to repay the loan, that may not be guaranteed. Now, most of these policies are going to have an external gap collateral that's required to be posted. This is a value that's the difference between the total premium that's been borrowed and the underlying cash value of the policy. Typically in the early years, we'll see anywhere from 5 to 10 years where there is an exposure there and the lender has to be fully collateralized. When there are assets collateralized for a loan, in the event of a default, they may need to be liquidated to satisfy the lender, the loan obligations. So that is a risk that's involved with financing insurance that's not involved with funding it directly. As well, the cash value of the policies, those are typically not guaranteed. Most of the contracts we look at are whole life or IUL. Occasionally we'll look at universal life contracts. We're not financing variable universal life. We're generally not financing any term insurance contracts. So these are policies that have cash values that we don't have guarantees on how they perform. We're going to be at the rate, we're at the mercy of the market. If it's an IUL, it's tied to the S&P index. It could be tied to the current assumption for the universal life policies, as well as what the dividend payouts are announced annually for whole life. That's not something that we know for sure how it's going to look. What we do know, though, is what the guaranteed cash value looks like for each of these contracts. And that's definitely considered into account here. Another risk that's involved with this is that if we need to turn to the policy's cash value for loan repayment, any loan or withdrawal from the policy is going to reduce the policy's value, as well as it could impact the death benefit. So we need to be very, very strategic about if and when we tap into the equity in the contract as a method of loan repayment or interest payment. So those are typically the risks that we're going to look into. Visually, many people ask, what's the structure here? And what I would say is that you could use this word trust pretty much, you could intersperse it with the word corporation or entity. So generally, a grantor is going to establish a trust. Let's talk about this from an estate planning, because this case is for, that we're going through this sample case is an estate planning case. This is a life insurance policy which will be owned in an irrevocable trust outside of the grantor's estate. So your client is creating this irrevocable trust. This trust is going to apply for life insurance on the grantor's life. We're going to secure third-party financing from a lender, which is going to finance the trust by directly funding the life insurance policy's premium. In return for doing so, the trust is putting a collateral assignment of both this life insurance policy's cash value and death benefit. It's a collateral assignment of the policy, as well as posting collateral to satisfy that gap between the premiums funded in the early years and the underlying cash value for the lender. Ultimately, the lender is going to receive all of the interest on this loan. We generally are going to advocate that clients are paying this annually on a regular basis and not accruing interest. So we're going to eventually have all the interest paid as well as the principal, and the remaining death benefit or cash value will be available for the benefit of the trustees, or for the benefit of the beneficiaries of the trust. That's the general overview of the entities that are involved. Now, there's two components that are unique to financing that a life insurance advisor definitely needs to be paying attention to. One is that ultimately we must repay the loan to the bank. All of the outstanding principal must be repaid. And while often we're seeing interest-only loans for many of the years, we do have to make sure there is a strategy in place for how to repay the lender in totality. And until the point that the lender is repaid, there's generally going to be a collateral requirement. Now, later on, when we have a mature policy that the cash value has grown in excess of all the premiums that are paid, that policy will generally self-collateralize the loan, meaning that the cash value is in excess of the total principal payments, and so it will satisfy all of the collateral requirements on its own. Until that point, though, we will have collateral that has to be posted in an outside asset. So strategies to repay the loan. One of the things that we look at is we want to go back to the fact pattern that drove the decision to buy life insurance and to consider financing. If you remember, it was that third step in that three-point process, that a client has a more efficient use of capital somewhere else. And so if they have a better rate of return in their real estate or their corporation or their investment portfolio, what we want to look at is that those assets that they were able to enjoy the appreciation on while we were financing their insurance, when it comes time that either they've had a liquidity event, they've sold out of their real estate, or they are no longer as risk tolerant and they want out of the market positions that they were able to enjoy, we want to pull those assets back into this plan and use the excess growth of that to repay the loan and own the insurance outright. That would be number one. Number two is that we would look as a backstop, we would consider the cash value of the insurance policy. We're going to not typically look at index loans. We're going to look at what is a reasonable rate of return on these, what is a withdrawal versus a loan, what is a safe way to pull equity out of a policy if it's needed to either fully repay the lender or partially in conjunction with outside assets. We're always going to consider outside assets first and want to see a strategy that involves those. As a backup, we build these policies with strong cash values. That way, if we need to move assets from the insurance carrier's balance sheet to the lenders to repay the loan, we have the opportunity to do so. As well, for clients who are used to making significant premium payments, if they're used to making a couple $100,000 a year payment, and we've now financed those in-force policies and perhaps some new insurance, what we advocate is that they keep the cash flow the same if they need to. This is more the behavioral finance side, is that if they're used to writing a check for $300,000 or $400,000 a year to finance their insurance, and now their interest is significantly lower than that, they find that they just lose track of it. But if they keep making those payments to a side fund, which is earmarked to repay the loan down the road or to help them service interest down the road, it really makes the strategy more sustainable. It creates less headaches down the road. But we always have to be talking about and identifying ways to repay this policy, repay the principal for the loan the entire time the strategy is implemented. Now, until the policy is fully collateralized, the other aspect is we need to identify assets which can be posted as GAAP collateral. Now, these, depending on the lender, because each lender is unique, there usually need to be cash or cash equivalents. So that could be a cash position, T-bills. It could be a letter of credit from a highly rated bank. Cash surrender value of in-force insurance policies works as well. Those are typically going to be accepted by all. Some lenders will require that those assets are actually at their bank or their institution. Others will not have that requirement, and rather instead they'll be collaterally assigned via a contractual agreement to the lender in support of this. Other lenders will allow cash or will allow securities, marketable securities, stocks, bonds, positions to be posted as collateral. Generally, they're going to give about a 50% weight for a diversified stock portfolio, and somewhere between 75 and 80% for a bond portfolio. I always advise that if we're going to be using a securities account or bond positions as collateral, that as soon as possible in the process, we take that balance sheet, we take the statement from that wherever that money is held, and go to the bank and confirm, one, that they have an agreement in place for that custodian, and two, to confirm the value of it towards collateral. So that's just a best practice, is as soon as we think that securities may be posted. This is going to be reviewed on a regular basis. In March of 2020, we had a big market drop, if you remember. That was a time where banks were immediately going to look at their securities-backed premium financing deals, and they wanted to confirm, what is the value now that the market has dropped? Is this going to indicate a collateral call? Do these accounts still satisfy the outstanding collateral? Being proactive about that, making sure clients are aware of what that looks like ahead of time, definitely is something that we need to be doing.
Yeah, John, talk about it for a second in terms of the parties involved, because premium financing is not just the insurance agent or the premium financing company, or or the brokerage, right, or the CPA firm. So talk about the parties that you would recommend to be involved, because there's a third party administrator. We're talking about all of those things that make sure that the plan functions properly and there's no hiccups, right?
No, that's a great question. So a lot of times what we're doing, it's really project management is one of the big values that we bring to the table, because I think last time I counted, there's 6 parties who are typically involved with this. You have the client, the wealth holder themselves. On their team of advisors, generally there's going to be an estate or business attorney who's driving part of this conversation and the contractual and reviewing contractual agreements. You're going to have a tax advisor. Now, if we're doing a traditional loan, there's going to be a third-party lender. So we're going to have a bank that's financing the insurance. If we have securities posted as collateral, there's generally going to be the custodian of those assets. Let's see, who else? Then we have the advisor themselves, who has the relationship with the bank, their team, their agency at Raise the Bar, and then us as an outside consultant. So there's 8 parties that are typically involved in a transaction like this, and everyone needs to have full transparency. Everyone needs to work in conjunction very smoothly for the benefit of the wealth holder. But I think that the best way to do that is by getting everything out in the open. It's having documents reviewed early and in advance. It's understanding what is possible and what's not possible. Oh, there's another entity, or another would be in an irrevocable trust. You also have the trustee. So that's 9. Who the legal signer is on behalf of that. If it's a corporation, there may be multiple legal signers. And so, you have to really make sure everyone understands what's happening. Everyone has a voice in this. The decision makers are able to review things, and everyone brings a unique perspective to the table. And this is really a team effort that we're participating in.
Thank you.
Yeah, great question. And then as far as figuring out who that banking partner is, or where the best source of capital is, for every engagement, we go out to the market, just like we do for determining what the best insurance contract is at the time of inception. We're going to do the same type of due diligence for the lending. We're going to first start at private financing. If a client has liquidity, if they have liquidity in their estate and there's or income producing assets in their estate, we may be able to work on a private financing transaction where they're lending the assets to the trust or to the corporation to start building out this insurance policy. Now, that's definitely going to require them to have the availability of liquidity or funds. Some of the consideration is that they need to understand what the opportunity cost is of that. If you remember that initial discussion, that third point is the most efficient use of capital. If someone is sitting on a large cash position in their estate and they don't want to make a gift of it to their trust because it's not the most efficient way of transferring assets to the trust, we may be able to help work with their attorney to lend the assets to the trust instead. So still keep the value in their estate, but give the beneficial use of it to the trust for the building of this insurance policy. Next, we would look at margin financing. So for someone who has a significant securities portfolio, we may be able to lend directly at the custodial level, where we are going to borrow money at typically a LIBOR plus small spread rate against their securities they have. Depending on the relationship, depending on the custodian, that bank, we're typically going to find out what is the maximum loan to value, how much liquidity can they source to fund premiums, what is the term that's associated with it, how often do they need to make interest payments, and that's a place that we would go to as well. The next that we would look to is a relationship lender. Now, these are typically private banks or trust offices. These are institutions that have a deeper relationship with the client. Oftentimes, they have assets under management. They have a depository relationship. They are working with them at the business level or as a private banking for their family level. They're going to have interest rates that are higher than private and typically higher than margin rates. They're going to have terms that are typically 5 to 10 years. we're doing a deal right now with a private bank that's actually come out with a fully committed 10-year fixed rate deal. And that's what's available. If we have a private bank, or if there's the ability to introduce a client to a private bank, that could be a place that we look at. They're generally going to take the underlying policy as collateral and require that all the other external collateral is posted at the bank. So if that's an investment portfolio, if that's a cash position, they're going to want to have that in-house and on hand. Generally that's a $5 to $10 million relationship in totality that they want to have with the client for us to be able to consider a relationship lender. They're going to have floating rate deals at the core. It's generally going to be based on 30-day LIBOR plus a spread, and then either fixed with a swap or capped for a fee up front. And then finally, what we go to, if appropriate, is a transactional lender. These are lenders that exist solely to finance life insurance. They do not require any kind of depository relationship. Many of them don't even require that assets are posted with them or their bank in order to serve as gap collateral. They'll take a collateral assignment. They'll have a control agreement posted for money that's managed somewhere else. Now, while these are higher interest rates, it's higher interest rates based on the others, but it's very low interest rates compared to traditional commercial financing of other assets. If you're buying an airplane, if you're building a building, that's going to be a lower interest rate typically than those interactions would have. For the most part, we're going to see 7 years or lower for a term. We do have one transactional lender who does a 20-year term. Collateral is going to have to be posted. They're generally going to come at 100% of the guaranteed minimum cash value for the policy. So that's a whole life contract with no dividend, or an IUL or UL contract at a 0% return. So anything that's not guaranteed, they're going to look at a year-by-year basis to determine what that collateral value is. Your relationship with them is not going to give you any leverage. There's no discounts for having more relationships with them. They're generally going to be based on 1 year LIBOR versus 30-month, and they're going to typically have a floor, a LIBOR floor. Well, we're going to see that they have either 100 or 125 basis point minimum for LIBOR. So today, it's September 10th, 2020, and we're going to see around a 50 basis point 1 year LIBOR. They're automatically going to bump it up 50 to 75 points above that, and that's going to be the minimum floor for it. So that is another consideration for these. What that means is there's a little bit less risk, that we know that LIBOR can double. It can jump 75 basis points before it has any impact on the borrowing rate for the client. Now, for this specific case, Adam, I know your client, we were looking at putting together a $15 million insurance policy. It's in support of between $10 and $15 million estate tax exposure that they have right now and projected to grow over time. What we looked at was building this out using a whole life contract. We wanted guaranteed downside protection. We valued that there is a built-in exit strategy from the loan in the event that the markets don't perform by the accumulation of cash value from just the guaranteed perspective. When with New York Life, we know that they're a long-term, great conservative company, and that's where we landed with this. We built this out as a $15 million policy. It's funded as the 10-pay chassis, and it's at $802,000 a year is the premium required to fund it. So that's all the contract for the life insurance policy. Now for the loan, what we looked at, do you have a question? I saw you're on mute though.
Yeah, I just wanted to mention in terms of the company that we select, right? It's not always New York Life or Mass Mutual or Northwestern or Penn Mutual, or you guys review all of the different companies and you compare them to one another and see who gives the most dividends, what's the exit strategy is going to look like, right? So talk a little bit about that.
Yeah, so some of the work that went into before we arrived at this specific policy, we knew the client was a little bit market averse for their insurance. So they didn't want to tie the performance of the cash value to the S&P. They weren't interested in an index chassis. They were looking at UL and whole life. When we went out to the market and looked at what's currently available, what we found is that for the whole life carriers, this product was the most efficient for this client. So for the 57 best health class male at $15 million, we found that this policy being funded as a 10-pay structure, the guaranteed cash value as well as the projected with current and modified dividends, gave them the best chance of success. This funding at 10 years gave them a built-in exit strategy, which was important. They wanted the ability to exit this if markets crumble, if they needed to get out of the interest payment obligation. That's how we got here. But that's something that we do just as analytically as we go to the market of lenders. We're going to go and review contracts. We're going to look at, are there cells of efficiency? Are there certain ages and certain product types that it's just most efficient? But every engagement is unique. When we are asked to work on a case, we have no ties, we have no loyalty or allegiance. Loyalty is the wrong word, but we don't go to the same carrier for every case. We're going to go to the market and figure out what's most efficient for this client based on their unique fact pattern, their age, their health class, and what they're trying to accomplish. It's also based on their risk tolerance. And that goes into every engagement. So we find that whole life is used very often for those that want to have guaranteed cash value. That whole life becomes a significant part of it. The other piece is that we find a lot of people like both. A lot of people enjoy the story of IUL. They like the idea of taking some risk in the market for the upside performance of the cash value, but they also want that downside protection. And so we can get really granular as to a proportion of the two and use a portion of whole life and a portion of IUL in a policy where we know that the guaranteed cash value of the whole life will actually provide them an exit strategy for all of the funding for both policies. We're working on a case right now that's very similar to that. We found it's about 75% of the policy will be whole life, 25% will be IUL. It does give that client a little bit of upside potential in the IUL contract, but the whole life amount was determined based on being able to exit the loan completely in totality at year 13 for both policies if in the event he wanted to change his mind and get out of the strategy. So that was important for him. And those conversations have to take place as we really get granular around what's going on. But part of our process is that we're going to do this review with the advisor and your team, Adam, first before it goes to the client. And again, this isn't a sales pitch. This isn't a presentation or projection. This is an analysis. And so this analysis is typically the first one. And as we get more detailed and the team of advisors is able to review and discuss what really is most important to the client, it starts to get more and more clear over what the appropriate policies are, policy or policies, as well as where's the most appropriate place to go to for lending. Now, in this case, jumping into the lending, what we used here is, this is transactional rates. So if you remember from left to right on the screen before, we saw that the private financing is the most efficient for clients who have access to the capital, and transactional lending is the least efficient of the premium financing sources. This isn't that transactional lender rate. We know this is a rate that we can get the client based on the very preliminary information, and we can only get better from here. That's how we approach this. I know I can get them 2.9% based on an $800,000 a year funding. This is looking at 165 basis points over LIBOR with a 125 basis point floor. So we're looking at 2.9% from a transactional lender. This would be a 5-year term. This would be the client making interest payments annually in advance. The lender is going to require it to be 100% collateralized. They're going to be funding this annually for 10 years, so it's an installment loan where they're going to be making the $800,000 a year payment every year for 10 years and increasing the total outstanding loan. One of the values that we're going to look at here is, it's called retained capital. It's that third portion of the story that when a client tells us they don't want to fund insurance directly because they have a better use of capital, this client expressed that investing in real estate is earning them at least 8%. So that's a number we're going to include in this analysis for us to talk about. The benefit of this is that you're able to grow your money outside at that 8% rate while we're building your insurance policy in a very conservative capacity. Now, this lender as well, we're showing that they are going to value the cash value at 95% of growth over time. So we're going to use 95% as the internal collateral support so we can look at what the outside collateral requirements are. One thing that you'll see on our illustrations very clearly is that we believe loan interest is not deductible. We advise that you definitely talk to your tax advisor about this. Many times this is marketed as a reason to work with one team or another. This is something you absolutely have to talk to your tax advisor about, and we don't believe that it is a deductible expense. So this is the analysis. And I'm going to pull a pen up on the screen so we can go through it together in a little bit more succinct order. But really, there's 3 different sections of this that we're going to look at a time. We're going to start here in the middle. So these middle columns, what this looks like, this is the illustration from New York Life in this case. So this is just the values from their carrier illustration. You're going to see that this is a $800,000 a year 10-pay. So we're going to see the premium payments going out for 10 years. We have the cash value columns in the center. This is the guaranteed cash value with no future dividend announcements. And this is the non-guaranteed at their current dividend rate. Now what we're going to see is the life insurance based on this dividend rate is going to increase over time. While it starts at $15 million, as early as year 3, we're going to see that the death benefit increases over time, and it does so for perpetuity, while there's no stress in the policy and while these dividends are announced. Any questions on that, Adam?
No, that's pretty clear.
Okay, and that's pretty clear. This is what, excuse me, this is what a typical life insurance illustration would look like. If you look at the carrier illustration, that's exactly what you would normally see. Now, the second piece that we'll look at is the financing. In this case, this is third-party financing. So what we're looking at is each year, we're going to borrow an additional $800,000 of principal. And that's going to match the premium that's going into the policy. So we're going to see it increasing every year for 10 years. This column 3 is going to show what the total loan balance is. So it's going to increase by that $800,000 a year for 10 years and then stop. And the reason is that we're showing that every year when the interest is calculated, the client is making that interest payment out of pocket. They're paying interest annually and in advance. They're not accruing any interest. They're not deferring any interest. They're staying on top of this loan. So then, whenever you add these columns, and these columns, when you add them together, what happens is we arrive at these. My mouse is jumping all over the place. That's really helpful. What we have is this collateral column. And this is, I think, the biggest consideration because it's very unique for a life insurance structure to have a collateral requirement to do so. When we have the financing, this is calculated as the difference between the total loan balance and the cash value. Now, most of them are going to use this value here, the guaranteed cash value or the no dividends. Some lenders actually will allow whole life policies to be credited for collateral at the current dividend rate. So it is different lender to lender. And what we say is that this is either the collateral or the equity, because ultimately what we see is that the cash value of the policy is going to eventually eclipse the total outstanding principal. And when that happens, now we have equity in the policy. We have equity in the policy in excess of the total outstanding loan. Until that point, we have collateral. What you see here is we're projecting about a $1.1 million collateral exposure. That's at the current dividend rate. If we look at the guaranteed columns, it's about 1.1 also. I think a lot of this driver is that for our calculation, we're using a 95% crediting of that underlying cash value. So with the current dividend rate, we see that we eclipse that outstanding loan in year 10. And because of the strong guarantees of this product, we see that from purely guaranteed standpoint, by year 12, we won't have any external gap collateral requirement. This will be a fully collateralized strategy from the policy values alone.
Yeah, and which
now,
and generally speaking, companies like New York Life and AAA rated companies generally outperforms the guarantees. But it's great that we're showing the guarantees as a background, right?
Well, I think it's important. These are all contracts, and the contract states that this is going to be the guaranteed minimum cash value. So we want to know what does the contract say? And I think it's really important to have it out in the open and available, and look at what is the difference between the current dividend rate and the guaranteed no dividend rate, so we can see what is that entire range of outcomes that the client is going to be exposed to. They're going to land somewhere between those two. So let's show the whole chain. Let's show how wide it is. Let's show what the difference is so we can plan for wherever we land to make sure it's acceptable. Because if if it's not acceptable for a client to land here,
Right.
if this guaranteed minimum that the contract states, if that's not an acceptable result for the client, we want to have that out in the open well before they're facing it, before they ever implement it.
Yes.
And so I think it's in our best interest and the client's best interest, certainly, to understand what does the downside look like.
Yes. Also,
But now I think, oh, go ahead.
John, talk a minute in regards to the funding structures of the annual interest outlay, because we know that there is a few ways to do it, using gifting or using different types of structures as opposed to that. If you can touch on that, that'd be great.
So there's the lender. So there's a few things to keep in mind. The lenders are generally going to require that this interest payment is made by a party to the transaction. So they're going to want to receive, they're going to confirm that it's received by somebody who's tied to this transaction. That could be the insured, it could be the grantor, it could be or a guarantor, it could be the trustee, the ownership entity. For them, as long as it comes from a party to the transaction, they're generally going to accept it and apply it. But what I think is really important to remember is that there are other considerations. We had a client earlier this year that almost mistakenly paid interest on a loan that's owned by their irrevocable trust. The loan is to the irrevocable trust. It's funding insurance that's owned by the irrevocable trust. There's no attachment back to their estate. However, they almost wrote an interest payment from their estate. And that's something that we jumped on the phone immediately with the estate planning attorney to make sure that this is documented right, that they needed to have documentation. They were gifting that money to the trust before the trust made the payment. We wanted no opportunity for this veil to be pierced around irrevocability. We wanted to make sure that things are done right. And that's why it's so important to not just do whatever the lender says is okay, but to understand what the ramifications could be for planning. That was a $48 million insurance policy. And if that got pulled back into their estate because the IRS came back and said that this was done incorrectly, or that it wasn't actually, you were paying for it directly, you had ownership and direct control, if they were able to make that argument, that would have been devastating for the client. And that's something we just have to avoid at all costs. So there's lots of ways to make the interest payment. It could be cash flow from assets that are owned by the trust. It could be gifts to the trust or excess growth of assets that are in the trust. There's lots of ways to do it. But I think what's really important is to make sure that the way that it's done is signed off and approved and reviewed by everybody who's involved with the overall plan. The estate planning attorney should definitely be consulted on this. The tax attorney needs to make sure things are done efficiently. There's lots of ways to make interest payments, and there's a lot of ways to do it wrong. And we want to make sure that the second part doesn't come true. Yeah. So kind of going back to the structure, when we arrive at this, the combination of the two, the policy and the loan, the other thing you're going to notice is that we have this column called net life insurance proceeds. And what this means is that in the event of a premature death, if the client were to pass away while this loan was outstanding as is, this is the amount of death benefit that we're projecting would be available for their beneficiaries. And this is really important. If this is an estate planning engagement, if we know there's a dollar amount of estate tax that's going to be due and we're planning for providing that, it's this value that we have to pay attention to. If this is in support of a buy-sell agreement for a corporation and there's a set dollar amount that needs to be available, this is the value we need to pay attention to. And what you see is that when we finance a whole life policy, generally we're going to see this dip occur, where if for the first 10 years, we go from about a $15 million net death benefit down to 8. And the way that this occurs is that this column is calculated by taking the gross death benefit in the insurance contract and repaying the lender first. And the remainder is what's available for the beneficiaries. So you see that in the first years, while the death benefit is growing, it's only growing by about $1.1 million to $1.5 million. However, the loan that's attached to it is growing from $800,000 to $8 million. So we have $8 million of additional pressure that has to be repaid in principal back to the lender, and only $1.5 million of additional growth the policy is projected to provide. And so that's why we see this drops by about $8 million, almost $6.5, $8 million, somewhere in there. And what we need to do for planning is make sure that this amount is sufficient to cover it or change the structure. You know, I know, Adam, for this client specifically, we're projecting that right now the estate tax exposure is around $10 million, projected to grow closer to 15 to 20 over time. And that's why having this decreasing death benefit in this conservative structure was acceptable to them. That in these years where it's under 10, I think your client said, yeah, I definitely don't want to die there. Yeah. Whenever we discussed it with him on the phone. and it's something to be aware of, that if that number's not right, if that's not sufficient, we need to make sure we're modifying this or creating some kind of structure to support the right value amount. But that's how we arrive at this calculation. And what you'll see is that over time, we start to catch up. After about a year 11, we no longer have any increasing loan, which is creating drag on the death benefit of the policy, but we do have projected increase in death benefit. And that's going to start re-increasing this net death benefit amount that the client's going to have for their beneficiaries. You know, ultimately, what we'll see is that if we are making interest-only payments on this loan, that to life expectancy, we're back up around $20 million of net death benefit. And that's calculated by taking a policy which has grown from 15 to $27 million of death benefit, subtracting out the $8 million of outstanding loan if it was still in force, and then having a resulting almost $20 million of death benefit. We include IRR columns, and then as well, you know, a lot of times we'll discuss the retained capital. What is the reason someone's choosing to do this is because in this case, the client believes he's going to earn 8% on his real estate portfolio. So what we're showing here is a calculation of the assets that he would have paid to fund this policy directly. Because we knew the $15 million policy was exactly what he wanted to buy, if he needed to fund this out of pocket at $800,000 a year for 10 years, he would be, the opportunity cost of this would be he wouldn't be able to reinvest in real estate. So what we want to show is tying it back in, saying, if we still earmark this $800,000 a year towards the plan, remember we talked about strategies to repayment, is earmarking funds or creating a side fund. If we earmark this $800,000 as part of the overall plan, we are using $23,000 in the first year towards interest payments. The remainder is going back into his real estate portfolio, growing at 8%. The next year, we have another $800,000 cash flow entry. We're projecting that we have about a $50,000 interest payment that year. So the remaining $750,000 is adding on and compounding. So we're growing retained capital on the outside where he's reinvesting in his businesses, and we're keeping that number here. And the reason why is that many people, when they see this analysis, they ask a question of, when are we paying off the loan? You know, is it sustainable to have an interest-only payment for forever? The answer is maybe. We don't know, and that's why we that's why we run this analysis in this format. Is we want to be able to talk through with the client and the entire team of what is the strategy. Is there a time that we want to project out or have a plan for exiting this? Because what I see from my perspective is that when we're tying all of the pieces together, is that at any point in time, if the client truly is getting this outside growth on their assets, this 8% retained capital, and they truly valued buying this policy, if those two things are true, at any point in time, they can exit this structure very sufficiently, very efficiently. And what I mean is this: if in year 5, the client had invested money outside of the policy and grown it at 8%, and they had a $4.6 million liquidity event of the appreciation of this, that $4.6 million is higher than the $4 million loan. They'd have about $600,000 of appreciation that was not accounted for. They had the benefit of growing because we used financing, and that's just their benefit. They grew $600,000, and it took them about $350,000 of interest payments to earn it. It's about 100% return on investment that we're able to get them from the interest that was serviced to them appreciating outside. You know, that's one year that we would look at. If we looked at year 11, same thing. We have a $11 million outside asset value, and we have an $8 million total loan. There's $3 million of excess growth there that they have been able to realize because we were using financing. And at that point, what would happen is there would be no more interest payments. There'd be no more out-of-pocket servicing of this. What would happen is there'd be no more collateral. There'd be no more net death benefit. There'd be no more retained capital. Maybe $3 million if they want to keep showing it. But what this would result in is that we're back on the policy. This is the part that we all know, Adam, is that now we have a paid-up policy that's performing exactly as originally planned. We're showing that between $8 and $9 million of cash value from guaranteed to current projections. We have a $16 million paid-up policy that with a $15 million guarantee. And that's the power of this financing. It's not free insurance. It's not low-cost insurance. It's allowing someone to use their assets most efficiently and with their eyes wide open over what all the moving parts are to get there. Now, the other question is, what if, we talk about risk exposure. What if this didn't happen? What if they were banking on an 8% return and they were in all commercial real estate during a pandemic? That businesses all now made an exodus to working from home. Retail locations were closed up, not paying rent. What if they needed to sell out of everything at a loss? What if this retained capital dream did not come true? Well, what that means is that, after 10 years, fortunately, we wouldn't need collateral. We'd have an internally collateralized policy, and then we can make a choice. With the loss of all that outside assets, is it still sustainable to make this interest payment and keep this strategy going? Does it still make sense to need this policy? What kind of modifications can we make? What's nice is that, as mentioned before, in as early as year 12, if there was no dividends announced on this policy from the day of inception, we would be able to exit this gracefully and not have any more collateral disappear. Now, in the event that we had any kind of market growth, we may actually have made some money in the cash value. In this case, there's about $1.4 million of growth, which would offset part of the carry cost in the form of those interest payments they've been making. Mm-hmm. So anytime that we review this, we're going to look at it in this format where we don't have an illustrated exit. We don't know when it's going to happen because the flip side is this. If the client's earning 8% on their retained capital and they're making money doing it and their risk tolerance hasn't changed and they say, Adam, I'm going to keep investing. I thought I was going to be out of the real estate game when I was in my 70s, but I'm not. I'm getting better at it. I'm making more money. I want to keep this going. Well, here's the beauty of it. Because we didn't build this on the predication of exiting it, let's jump to year 14. Let's look at how this looks. In this year at 70, where we thought maybe we were going to see an exit, the client's paying, we have a projected $300,000 interest payment. What is the benefit of that $300,000 interest payment for them? Well, what it's doing is it's allowing $8 million to work at this 8% growth that they have. So they're getting to appreciate their assets at 8% for this carry cost. The other thing is that the insurance policy is growing in cash value $500,000. The death benefit's increasing $500,000. So by making this $300,000 interest payment, by keeping the loan in force, they're growing $8 million in the retained capital. They're compounding this $10 million in a tax-deferred basis in life insurance cash value. They're increasing this death benefit, which is going to be tax-free because it's in an ILIT. There's all of these benefits to keeping the loan on the books, if it makes sense as well. And that's what we want to talk through. We want to talk about the entire range. What if we keep the loan for perpetuity? What if we exit it based on a risk change and the appreciation of capital assets outside? What if we need to get out of it from internal cash values? What if we die prematurely? Those are all going to be drivers to exiting or keeping the loan. And we want to make sure we're talking through the entire range of outcomes, not setting expectations to the client that they're going to make 10 or 15 interest payments and be done. What I want to do is make sure they understand that this is a comprehensive strategy with a lot of variability. They can customize this based on their future situation. So that's what we go through. This is, we run it through age 100 generally for clients who believe they have extreme longevity or long family history. We'll definitely run this as needed. The whole life policies are great in that these are endowed. They're going to run forever. That's really the presentation. What we look at as well now is I think the biggest hurdle to a premium financing case is the collateral conversation. It's understanding how collateral exposure is calculated and how it's serviced and what the whole range of collateral outcomes could be. And so what we look at is we build this range of outcomes calculation from the current dividend down to the guaranteed no dividend announcement values. And that's what you're going to see here. We know what the loan's going to be based on 10 years of funding over time. It's going to grow from $0 to $8 million. We know what the guaranteed cash value is from the contractual obligations, and we know what the illustrations are based on the current dividend. And whenever we apply a 95% weighting of the cash value, that's where we see that in year 10, or this column here, in year 10, we're projected to have no other outside collateral requirement at current dividends. And in year 14, at 95%, we'll be in excess from a guaranteed perspective by year 14. Now, what this looks like visually is this is the range of outcomes. This is what we see. This pink line is the increasing principal. So you see it literally grows linearly for 10 years up to that $8 million mark. And we have these curves showing the projected cash value. The top level line is the current assumption for the dividend, the current dividend announcement, and the bottom line, this is the contractual minimum. And again, what we know whenever we look at it this way, we're not telling the client where they're going to land, except it's going to probably be somewhere in here. It's going to be somewhere in this channel. And if it's acceptable to be in, to not have any collateral at this point and to know what the net death benefit is from a guaranteed basis, then this may be a great fit for them. But that's the whole analysis that we go through. We review this with, again, with you, Adam, with your advisors first. Once it's been approved and reviewed by them to make sure that there's no misspellings, that it's something that they think would be valuable for their client. We have a conversation just like this with the client and their advisory team, where it's the disclosure, it's the presentation, it's the explanation of how financing can work, how we would approach the engagement if they chose to move forward, policies that we think may be most appropriate based on our preliminary run of the market. And if they give us the green light to go ahead and go through underwriting, there's two phases of it. There's the typical phase, which is the insurance underwriting. We have to go to the carrier and make sure that the carrier is able to underwrite and write the contract for them based on their risk assessment of the client's mortality and their financial requirement to have this policy, the death benefit amount. And we can do it in succession, or at the same time, we can go out to the lender market where we compile a full financial packet, personal financial statements, documentation to support values, corporation values, real estate values, tax returns. So we go out to the market of lenders and we secure competitive term sheet offers where we're going to have documentation of what the different lenders and the relationship requirements are for each one, so we can present that back to the client and their team as well, where we can really get granular on what's the required term length of the loan, what is the most efficient spread over LIBOR, what's the best floor rate for them. If we're trying to create a cap or a level rate based by purchasing a swap to go with it, this is where we're going to get really granular over the specifics of each loan individually. So just as we go to the market and create a custom recommendation for the policy based on the client, we do the same thing at the lender market. Ultimately, once we have approval from both the carrier and the lender, we marry those two together by putting the policy in force, filling out and signing loan documents to effectuate the loan, assigning the policy over, and then posting the external gap collateral. Once the lender is fully collateralized from their perspective, once the carrier is fully issued a policy and it's ready to receive funding, that's when the premium transfers from the bank directly to the carrier, and we have an in-force policy.
Yeah, talk a little bit about expectations in terms of timeline, expectations in terms of who is the right prospect or client for it. How should the broker or the CPA or should the trusted professional should reach out to Balanced Strategies through RTB or Raise the Bar Financial Group? Talk about a little bit about those things.
So timeline is definitely unique. I think it really depends on the amount of planning conversations and the readiness of the client to go down that path before we start talking. So if the client's gone through comprehensive estate planning, if they understand their estate tax exposure and they've identified that insurance is the asset class to do so, they're on board with buying it in the most efficient way possible, and then we're engaged, then it becomes a really easy decision of, are we going to finance it? Or are we going to pay it out of pocket? What's the most efficient way to fund that contract? If that's the case and they haven't yet started underwriting, it's just like a typical case. Depending on the carrier's responsiveness, depending on the availability of medical examiners, you've seen it's been delayed now as people are getting used to working from home, and the increased caseload. That could be anywhere from 8 to 10 weeks to go through full comprehensive medical underwriting, financial underwriting at the carrier level. There's no difference there in our process whenever we're doing financing, as long as we're doing the financial underwriting at the same time. Because the financial underwriting, what I typically see is we'll put out a request for a loan packet, and that's going to be the full comprehensive documentation to go to the lender and secure their offer. I generally see that process taking about 30 to 45 days, depending on the client. Now, if we're able to be connected to the client's CFO, their CPA, a controller, or I'm amazed, but the real estate clients who are used to jumping on deals, I've had a client who had the whole lender packet to me within 5 minutes of getting off the call, because he always had it ready. He always needed to be able to go to a lender and jump on a deal. And so depending on how organized and how prepared the client is for that, I've seen it anywhere from 5 minutes to a couple months.
Yeah.
But that's something that we work with, and definitely request from an efficiency standpoint connection to someone who's the best person to help coordinate that on the client's behalf. Once we have the entire lender packet, it typically takes us about a week to get a term sheet from each lender. That's going to outline their preliminary terms, what the loan rate is, the requirements for a relationship if there is one, what they accept as collateral. We compile that into an analysis again and bring that back to you and to your advisor and the client to discuss what the lending options are out there. If we're looking at private banks, we advocate that the client definitely interviews the teams which they would be working. So we'll help coordinate time for them to interview and understand what it's like to be a client of that private bank if they're going down that road, if it's a new relationship. If it's already an existing relationship, generally we just include them with the transactional lenders to make sure they're getting a competitive rate. But then it's much easier to move forward because they're typically pre-approved internally because they already have a relationship. From the time that a term sheet is signed off on and approved, it's generally 1 to 2 weeks to get a formal loan document package. And that's going to have all the information about the policy being assigned over. It's going to have the promissory note, the agreements, all of the collateral assignments for the outside gap collateral, et cetera. That's going to be really dependent on the policy being approved, though. So that's why I recommend doing them both at the same time, because the loan documents aren't going to be generated until we have the final formal ready for issue policy. So we're going to need the policy number. We're going to have confirmation of the titling. We're going to need to make sure we know exactly what the funding requirements are. All of that needs to be finalized in order to have the lender draft the loan documents. And once the loan documents are all signed and endorsed, generally they're going to require notaries. We're going to have an interest payment made, and then we're going to have the gap collateral posted. Once all those things take place, which I generally see takes another 30 to 45 days, that's whenever we'll be ready to have the policy funded. So I generally see it's about a 120-day process from the time a client gives us the green light to being fully through underwriting, fully approved at the lender. We've confirmed what the final lender is. We've posted collateral. We've signed loan documents. We've made an interest payment, and ultimately the policy is funded and put in force. So it is a longer process than just the medical underwriting for a carrier, but it doesn't have to be much longer, especially if we have a client who's looking to get something done by the end of the year. If you think about today's September 10th, it's definitely crunch time for people who want to have policies financed and put in force by the end of the year. We only have a couple weeks to a month to be given the green light to give them the best chance of these policies funded by 2021. Yeah. And that's an important deadline to remember for advisors, because we have to get the green light before we can start going to work. And we can work as fast as we can once we've given that green light, but we have to get there before we can start getting all the underwriting done. So just to keep in mind, just like insurance carriers who go through an end of year push, that drives the lenders to be full as well. And so understanding that they're going to have to prioritize, and there are going to be sometimes delays in the processing time. The sooner we can get moving for a client, the better, especially for year-end cases.
Yeah, and it's important for advisors to know that they're not selling a product here. This is again, a complex strategy with a lot of moving parts, and setting the expectations is really, really important, because it also helps the process. And if there are any hiccups along the way, we can always refer back to the expectation that we set early on. I also wanted to talk about what is a use cases for premium financing, ideal clients, asset size, business cases. So, agents, advisors could really have their antennas up to understand where is it appropriate and where is it not.
So, we focus on on cases that have a death benefit need, which is tied to an overall plan. So our team's not really focused in the income generation. It's not the increase in cash value to project an income. That's not where we're focused. We're focused on death benefit planning engagements. And so that's generally going to be clients who have a current or anticipated estate tax exposure. So a married couple today, in excess of $22 million of net worth, are projected to grow significantly over that. For an individual, about $11 million. For businesses, many times it's a $20 million corporation or above, where there is a significant exposure from a buy-sell perspective, or for key person coverage, where we are building out policies to benefit the key employees or for the ownership of it. From a lender perspective, the minimum case size that we can do is $100,000 per year of premium. That's the lowest loan amount that they'll consider. Most of our cases are falling somewhere between $400,000 and $2 million a year of premium. And there are breakpoints that happen along the way. We'll typically see that over $500,000, there'll be a discount. Over $1 million, there'll be a discount. Over $1.5 million, over $2 million, we'll see discounts into that loan spread as we break through those amounts of annual premium. From a carrier perspective, most carriers have a $5 million requirement net worth of the client for them to approve premium financing. We have seen some that'll go on an exception level basis, depending on the fact pattern, down to $3 million. But what they want to see at that level is that they have a client who's truly using financing to benefit their outside assets. They're not putting all of the pressure on the policy to perform. They're planning on using external assets to repay the loan. They're paying interest all year, so they're not accruing interest. Those kind of facts are going to go into it. For a carrier wants to see that it's a conservative design, that it's not speculative financing, that you're not accruing interest and hoping the cash value covers that increased loan, that you're not banking on a loan repayment from policy cash values. They want to see something that's much more risk averse if they're going to approve it at that $3 million mark. That's what I generally see. I think an ideal case is someone who has a significant concentration of their wealth in real estate or in a privately held business. Those are probably the two most regular fact patterns. It's someone who values life insurance as part of their planning. They want to keep their family business in their family. They want to keep the properties that they fought hard to build and maintain. Those are the assets that are worth value, and they want to keep those in the family and be able to pass them down efficiently. And because of that, they know that they have very efficient growth. They have projected growth of the asset value. There's great cash flow. They want to keep those properties running, but they also need life insurance. And that's where I encourage advisors to ask a simple question, especially for real estate advisors. Folks who have built their business on borrowing, is asking the question is, what if we could help build your life insurance portfolio the same way you built your real estate portfolio, by using other people's money? And asking that question generally will open the doors. What do you mean? How would that work? What would that look like? And that's when I say, let me bring in a team. I want to bring a consultant in that we've worked with that works in this arena all the time. I want them to present to us how using financing could be used, how financing could be used to fund life insurance policy. Would that be okay? And if they say yes, that's where we start the fact-finding process. I don't need a lot of information to start, but I definitely need a high-level overview of the client and their financial picture. I need to know their names, date of birth, the anticipated health class, all the same information we need for life insurance underwriting to determine what's available. Just like life insurance underwriting for death benefit capacity, we need to understand what is their income, what is their overall net worth. For financing, though, I want to dig a little deeper. I want to ask, what is the concentration of their net worth? How much of that is in real estate? How much of that is in marketable securities? How much of that is in a closely held business? How much of that is in in-force life insurance? What are the cash values of the in-force policies? Because we need to know capacity. And with that general information and why we're purchasing the policy, we can go to work, create the analysis, and start the conversation.
Yeah, fantastic. Wow, John, it's been really, really insightful. A lot of great information. I mean, this is exactly why we chose Balanced Strategies as our go-to for anything in regards to premium financing. Your breadth of knowledge and your expertise, yours and Justin and everybody that I worked with in Balanced Strategies is really above the rest. So I want to thank you and express appreciation. And I look forward to doing many cases with you guys.
Yeah, likewise, and thanks for trusting us. I think one other thing I'd point out just at the end here is that, you know, we're not a premium financing shop. We're not a team that exclusively works in premium financing. Now, we evaluate financing for every case because for high net worth clients that have opportunities, unique high value opportunities, this could be a very efficient way to fund their insurance, but it's not a requirement to work with us. You know, we're definitely in support of complex planning. And so even if you have an advisor or you have a client that you're working with that has a client that, a wealth holder who has a complex estate, has a complex business, has significant wealth tied up in these concentrated areas, and they're trying to figure out what kind of planning can we do? What kind of planning should we do? That's a great time to ring the bell and ask the question, what does it make sense for, you know, how do we approach this? What have you seen? And even if it's an introductory call, a fact finding, if you need to lean on our team to help with discovery in coordination with you, Adam, that's an area that we can help out as well, because we can dig into, you know, concepts like dynasty trust. We can get into the buy-sell agreements and the succession planning. And I think the earlier we're tied in with the planning team, the more value we can provide, the more insights and stories we can share about what other clients have done successfully, where areas have been things that people have tried but, you know, aborted halfway through or decided was not most efficient. We can give that historical perspective on the planning side as well as on the insurance and financing side. But Adam, always a pleasure to see you. I can't wait till we get to do so in person again, and I hope this is very helpful. Thanks for asking me to jump on today.
Thank you so much.
All right, be well. Take care.